All right, today we're cracking open the books on a company that's famous for stirring up more than just coffee. Black Rifle Coffee. We're going to find out if this is a powerhouse brand brewing up growth or if it's just burning through capital. Let's get into it. So here's the big question we're trying to answer today. Is Black Rifle Coffee's super strong brand actually backed up by solid financials? Or is this whole thing just sizzle and no steak? That's what we're here to find out. Okay, so first things first. Before we can even begin to understand the numbers, you have to understand the brand. Because with these guys, it's not just about selling coffee, it's about selling an entire identity. So what's their whole deal? Well, you gotta get this. They are not trying to be the next Starbucks, not even close. They're a premium coffee company that is laser focused on a very specific niche, a community with really strong ties to the military and conservative values. And this approach, as we're about to see, is both its greatest strength and its biggest potential weakness. So how do they bring in the cash? Well, it's a pretty straightforward three-pronged attack. First, you've got the direct-to-consumer subscriptions. That's your nice, steady, recurring revenue. Then, they do wholesale, getting their coffee into other people's stores. And finally, they've got their own brick-and-mortar retail shops. All right, so that's the brand story. It's powerful, it's clear. But do the numbers tell that same story? It's time to crack open the books and see what's really going on under the hood. And wow, right off the bat, you see this number, and it's pretty impressive. Almost $400 million in revenue. That tells you they've absolutely found an audience and their brand is working to drive sales. But, and this is a very big but, revenue is only one piece of the puzzle. And here's where the plot thickens. Despite all that money coming in the front door, the company is actually losing money. A negative net margin of almost 3%. That's a massive red flag. It's a clear sign that their expenses are just out of whack. So you have to ask yourself, where in the world is all that money going? Which, of course, leads us to the single most important question for any investor. Is this company taking shareholders' money and creating more value with it? Or are they basically just lighting a pile of cash on fire? And here's your answer. A return on equity of negative 55%. Let that sink in for a second. That means for every single dollar a shareholder has invested in this business, the company is actively losing almost 55 cents. That isn't just inefficient. That is the literal definition of destroying shareholder value. Okay, so let's zoom out and look at the financial health snapshot. There is one genuine bright spot. Insider ownership is high, almost 24%. That's great. It means management has skin in the game. But that positive is getting crushed under the weight of some serious weaknesses. They're bleeding cash, they've got a ton of debt, and as we just saw, their ability to use capital effectively is, well, just plain poor. So let's really zero in on the biggest risks here. The core of the problem really boils down to two things: those terrible profit margins and the fact that they're not generating any cash. On top of that, they're playing in an incredibly crowded and competitive market, all while carrying a ton of debt, which puts their whole balance sheet at risk. This weighted SWOT analysis really puts everything into perspective. Just look at how the two biggest weaknesses we just talked about, the weak margins and negative cash flow, are given the heaviest weights. They are the biggest drags on the company. So even with a real strength like brand recognition, it's just not enough to lift the final score. A 3.65 is pretty low, and it reflects some major challenges. Okay, we get it. The business has problems. A lot of them. But what does that actually mean for the stock price? Let's switch gears and try to figure out what this company is truly worth. Now, this slide is absolutely key, so pay close attention. Using a couple of standard valuation models, the analysis pegs the company's intrinsic value somewhere between 72 and 85 cents. Now, look at the current market price, 84 cents. It's already trading at the absolute top end of its fair value range. To put it bluntly, there's no bargain here, no margin of safety. And looking ahead, pretty much everything comes down to whether or not they can fix their profitability problem. In a bear case where things don't get better, this is a 50-cent stock. In our base case, with some modest improvements, maybe it's worth 75 cents. You'd have to believe in a really optimistic home run bull scenario to see this thing climb up to $1.20. So if you're an investor looking at all this, how on earth do you decide on a smart price to even consider buying? Let's take all this theory and turn it into a practical guide. Let's set a concrete goal. A pretty common target for long-term investors is a 9% average annual return. So what price would you need to pay for Black Rifle Coffee today to have a realistic shot at hitting that goal? And check this out, because this is fascinating. Your personal timeline completely changes the math. To get that 9% return over just 5 years, you need to buy in at 70 cents. But if you're willing to wait 16 years, your entry point has to drop all the way to 50 cents. It makes perfect sense, right? The longer you have to wait for the business to maybe turn around, the bigger the discount you need up front. And this gets us to one of the most important concepts in all of investing, the margin of safety. Given all the risks we've talked about, a smart, prudent investor wouldn't dream of paying fair value. No way. They'd demand a significant discount. We're talking at least 30% to protect themselves in case that big turnaround story never actually happens. So we've dug through the brand, we've gone through the ugly numbers, and we've calculated its value. It's time for the final call. Should you invest in Black Rifle Coffee? The verdict from this analysis is about as direct as it gets. At its current price, the advice is to avoid it completely. It only even becomes a consideration for an investor with a very high tolerance for risk, and only if the price drops below 50 cents a share. So what's the magic number to remember from all of this? It's 50 cents. That's the price point that gives you that margin of safety and a fighting chance to hit that 9% return over the long haul. That is what a disciplined entry point looks like. So let's sum up the key takeaways. First, and this is a huge one, a powerful brand does not automatically make a great business. Second, the financials right now are just plain weak. We're talking negative margins, negative cash flow, and high debt. Third, the stock is already trading at its fair value, which means there's no discount for all the risk you're taking on. And finally, any hope for success here is a complete bet on a turnaround that is anything but certain. And that's our breakdown of Black Rifle Coffee. What a fascinating case study of powerful branding meeting some very weak financials. Now, I want to hear from you. What company's book should we crack open next? Drop your suggestions in the comments below.